Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. We're going to do a couple recaps, I think, this week. What's gold been doing over the last couple weeks in relation to the equities markets, which is something I was looking at earlier, and a breakout in the dollar to the upside, which excites me a little bit. But you brought something up here about an hour ago you wanted to take a look at, and I started looking at these charts too, and I'm like, man, sometimes I'm too short-sighted.
Mm-hmm. And that's the way we all are. You know, I started looking at the 5-year charts for gold, copper, and silver. And for silver and copper in the 5-year chart, there's quite a pennant formation forming. The gold 5-year chart is fascinating. You can see the 3 times we approached 2100, the first 2 times it hit, and then fairly significant pullback to the downside occurred. The 3rd time, we've been moving sideways.
Right. So when you see something like the first 2 moves in gold, and maybe I'll draw out sort of a theoretical move here. The first time we hit around 2100, we had a decline. We came back up to it a second time. Now, what's interesting about that is, although I think we did put in a slightly higher high the second time we hit it than the first time, the reversal back down was quite a bit more significant than the first one was.
Correct.
So there's something in the charting world I like to call the old Quasimodo head and shoulders. So it's where you have a head and shoulders pattern, but that second shoulder is hanging quite a bit lower than the first.
Right.
But when we came back in to put that right shoulder in, we came all the way back up to the top. And like you just pointed out here, we're not really seeing the reversal you would expect to see like we did the first 2 times.
Not even. And I know people are looking at from last week to now, you know, a sell-off in stocks, a dollar rally, yields rising in the treasury world, bonds suffering from that. And of course, gold is down. And they're saying, well, that's because of the strong dollar. I'm like, well, I think you're ignoring the fact that we're within weeks of closing out our fiscal year with a $2 trillion deficit.
Right. Possibly the highest deficit ever in a single year, despite the overspending during the vast overspending COVID period.
Right.
So business is not as usual, as they say. So yeah, seeing that triple top in gold and seeing the reaction when you look at it, not leaf by leaf, tree by tree, but when you kind of take a step back and think about the time span actually involved when you're looking at long-term market moves. I appreciate you causing me to pause and reflect on that. Now you're seeing a completely different picture when you're looking at some of the other more industrial related metals. So I'd love to hear what your thoughts are on, like you mentioned, silver, platinum, and then what we in the financial world kind of like to call Dr. Copper, which tends to be the mercury in the thermometer for the industrial markets.
That's very true. The 5-year on platinum emerges also like a pennant formation for the 5-year for copper and the 5-year pattern for silver. So I think we've got pennant formations forming in the industrial metals, and I don't think the pennant indicates a reversal to the downside. I think the white metals and Dr. Copper might finally have a rally.
Now, when we talk about pennant patterns, as you can see on the charts we're drawing here, there's a couple different terms for it. We like the pennant pattern. You can call it a triangle pattern. I like calling it a compression zone just because of what's actually happening there, where the highs are getting lower and the lows are getting higher. You know, the volatility between the highs and lows, the swings are starting to tighten down a little bit. So what that means is you're looking at a trading range, which in this case has been going on for a number of years, compressing down to a decision-making point. Now, when you factor in 5 years ago where the Fed balance sheet was, where interest rates were, what the national debt was, and how that's increased, there is a comeuppance of inflation that is going to continue to work its way into the markets. Now, I think this is something the 3 of us talked about last week, where Tori brought up this interesting pattern when you see metals or really any asset have kind of a breakout to the upside period of time. Generally, you're not talking about semi-minimal movements. I mean, we've got multiple times here over the last 30, 40 years that when gold moved, it didn't go up 50%.
No.
Went up 300%.
Yeah.
So when you have this compression period over a significant amount of time to a decision or what we call a breakout point, I agree with you. I think the amount of leverage that's been built into the system over the last 10 years, certainly the last 3 or 4 years.
Well, and that's key. It's the leverage.
Right.
Yeah.
And we're still coming off copper being at the highest price in history.
Mm-hmm.
Gold being at the highest price in history.
Mm-hmm.
Like, these are things that have already happened without having one of those breakout movements. So I'm glad you pointed that out, and I think the copper chart is very, very telling across the board for all other mined commodities.
We'll see. We can't be short-sighted, though. We have to look at where we are now and where we're going and how is this all going to play out. I don't think you can anticipate a deflationary cycle coming because the dollar expansion is too great. The Fed balance sheet, the M3, and the money in circulation around the world, and the de-dollarization occurring simultaneously. So I think that it would be unwise to say, well, it's all deflation, everything falls. Not everything.
You know, you mentioned deflation, Rob, and I keep coming across things that maybe we want to talk about this on the show. This may be something maybe you want to call your broker, your advisor here at McIlvaney Precious Metals and talk to, because there's something I think a lot of people don't realize is that gold actually does better in deflation sometimes than it does in inflation.
It can.
Because of the purchasing power and ability to convert that purchasing power into a currency that is harder to come by than it had been previously. So I don't know if we have time to kind of go into that explanation.
I wish we did,
Right.
because it's some fascinating stuff about the confiscation that occurred in the 30s, the revaluation of gold from $20 to $35, et cetera, et cetera.
Overnight.
Yeah, that the real point is that we are headed into an inflationary period. You don't see all the articles on the internet where people are saying gold's going to fall back to $100.
No.
They were out there, and of course they would always have to readjust. Well, gold didn't fall to 100, but it's now at 800 and it's going to fall to 600. Well, it didn't, and then it went to 1,000 and it's going to fall back to 500. Well, it didn't. It kept going higher, and the deflationists had to keep ratcheting up their doom and gloom for gold because gold was going to fail, but it hasn't. And here we are. We hit 2,100 the third time in the last 5 years, and now we're moving sideways, and it does look like gold is going to be moving forward higher.
It does. And I think as we reach these breakout positions for gold, how do you have a quadruple top? I mean, the line can only stay drawn in the sand for so long, right? I mean, eventually you have that breakout position. For silver and some of the other industrial metals like platinum, like copper, we're looking at.
Which is hugely undervalued, even though they're hitting their highs.
Yeah, well, copper is.
Copper
platinum
is,
and
not
silver
platinum.
still have a way to go.
Way to go. But copper is leading the charge, and it looks like it's going to break out. And I do think Dr. Copper is telling us that platinum and silver are going to be going higher. I do want to go down a brief road here because I know a lot of people are looking forward to hearing Tori talk about gold versus real estate. But Tori is out of town, so we'll have to save that for next week. In the meantime, we're simply looking at the market in metals today.
So talking about how copper tends to lead out for the rest of the industrial metals and showing us breakout highs and compressing and looking for a pretty significant breakout to the upside. You know what else tends to lead out its sister markets is the Dow Transportation Average.
Well, it sold off big time.
It did. And it's funny that we ended up having the copper conversation because when I was sitting at my desk an hour ago getting charts together, I said, I haven't looked at the transports in a while.
Oops.
Because for the last couple of weeks, I've been saying in here, I really want to see the Dow take one last gasp upwards before we have decline. Because the Dow Industrials have yet to put in a lower low, even though they've been declining for the last couple weeks as well. They're still technically on at least a kind of a medium-term upwards trajectory. But the transports, which the argument of Dow theory has been, one of the arguments has been, transports lead the industrials.
They do.
If you're not shipping goods and services to be sold, then those goods and services aren't being sold. It's a pretty simple concept. So I pulled up the transports today, and the transports put in a lower low this week, which now it's short term. It has been up for a number of months.
Yeah.
But just like the industrials, and we'll look at both charts here, just like the industrials, they've failed to get back to those previous highs by about 20-25% shy, at least in the transports.
So you're anticipating the transports leading the rest of the stocks down while copper leads the rest of the industrial metals higher.
Scary. It's scary when you have the raw materials that are used in the production of goods and services going up in price, while the companies that use those raw materials to produce those goods and services going down in value at the same time.
Yeah.
So that isn't recessionary. That is monetary, in my opinion.
We'll see. We'll always see. Next week will be a different week, but I keep hoping for the sake of our families and our country that there's bound to be some good news out there somewhere, but it doesn't seem to be. Things keep getting a little darker every week.
Well, I've got a little bit for you. I mean, the DXY, the dollar index, compared against the basket of other currencies globally, we did have a little bit of a breakout of its declining pennant. Now, one thing I pointed out last week, it hadn't actually put in a higher high yet. It did that yesterday, so it did that on Tuesday. So we're looking above the kind of end of May, beginning of June highs. So maybe my guess from 6 months ago, and we get back up to the 107, 108 level, wasn't wrong. The problem is I don't know if I can take credit for something when they've had multiple interest rate rises since I said it would happen.
Right.
So I don't think it necessarily counts. So the good news here is if you're converting your US dollars to marks or British pounds or euros or something else, you actually are getting a better exchange rate. Now, the problem is if you're not doing that, if you're converting your US dollars to goods and services here in the United States, you're getting a worse exchange rate.
So the moral of the story is go to Europe.
Maybe. So, I mean, how many years of my life has the British pound been significantly more valuable than the US dollar? Most of my, maybe all of my life over the last 40 some years. And we saw that push down to almost parity a couple years ago, I believe it was, where the pound dropped to within a few pennies of 1-to-1. So yeah, the exchange rate is definitely looking better. I'm not encouraging anybody to go live in Europe unless you want to. I'm not opposed to it. And now I'm probably digging myself into a hole for our European listeners. So wasn't my intention. Apologies.
Well, it is still 1 1/4, so.
Okay, so it's kind of balanced out between 1.5 and 1. So that's good to know. So yeah, interesting week. Big kind of decisions probably looming this fall. I know we've been doing the same song and dance all summer long. The summer's going to be quiet. Things are going to find where their bases are for their trends. We're going to bounce within trading levels. And when we get into September, October, November, something's going to start making some noise. And maybe this tiny little obscure dollar breakout to the upside starts causing some things to make some noise. Maybe the Dow failing to get back to the old highs and starting to show some weakness makes some noise. Maybe copper is going to make some noise, and that's going to pull some other stuff with it.
Well, and I am surprised that we are still here. As you know, I thought we would see some kind of change as the BRICS countries had their meeting when Jackson Hole occurred, and there was supposedly the announcement of a rollout of the U.S. CBDC, even though I don't trust either group at all, in my opinion, to follow through with what they are committed to or even be able to. I thought it would make some changes in our market, but it hasn't. So far, it's been nothing.
Well, and that may just be the patience game. Maybe we all need to channel a little bit of our inner Warren Buffett.
Yeah.
You know, I always liked his explanation. If you play baseball and you get up to bat and you watch 3 really good pitches go by, you're out. But in the investment world, you can watch tens of thousands of really good pitches go by, and you still don't have to swing.
Right.
Until you want to swing at the thing that you know the most about and you know you can hit it the hardest. So I think for me, at least, it's a good reflection that there's things you have control over in the investment world and things you don't. And timing is one of those. One of those things you just don't.
We're still in our trading range.
Sure.
You know, we're still bouncing between 1910 and 1980. And you said that was going to probably be the case. I was more optimistic than that, but you were right.
Yeah, I am constantly the office curmudgeon.
Yeah.
So, and I'm okay with that because I'd always rather be pleasantly surprised. So, lifelong pessimist over here. Pessimists are actually happier because we're constantly appreciative and surprised about the good things that happen to us. So, there are your life lessons from Miles for this week. Yeah, we'll see if the dollar can continue this. I'd like to see a little bit more of a dollar rally. Here's a question I'll leave with somebody who's been doing this longer than I have, and you've been watching this stuff longer than I have. And I, frankly, was a child during the last time we were in a rising interest rate market back in the 80s. So if we see the dollar index continue to climb over the next couple weeks, how do you think that plays into the next potential interest rate rise?
I think it's going to keep going. I mean, they're going to raise interest rates at least one more time, maybe a quarter of a point, and I think the dollar will continue to rise into that. But it's running into a lot of headwinds, Miles. There's just so many headwinds that the dollar is moving into, and we've talked about them constantly here. I just don't think it's sustainable, especially as you reconcile and close out fiscal year 23 in the next few weeks. You sit there and look at the bottom line, and the bottom line is not good. And the only way out is to continue to increase the Fed balance sheet and put more money into circulation to pay the bills.
Well, thanks again, Rob. I appreciate you joining me this week. Fun show this week.
Next week, Tori's going to bring his real estate charts in, and we're going to talk about gold versus real estate.
I think that's great. In fact, I have a client of mine who wanted to share some stuff from last week's show. So I just updated those and sent those to him yesterday. He wanted to share that with some friends of his. And I know Tori's been digging into that pretty hard. So, yeah, it's comparative assets, right?
Yeah. Because it's always something versus something else.
It is. And there are pros to what real estate offers.
Yes.
Long term, and there are pros to what gold offers. And I've always been a fan of the idea of they are very complementary hard assets as long as you approach them the right way. Yeah. So that's going to be a fun discussion next week. So we'll make sure we hold Tori to that. In the meantime, thanks again for joining us this week. So if you'd like to talk, we can be reached at 800-525-9556. You can also find us on Facebook. We're at McIlvaney Financial. We're on Twitter at ICA Gold. And our website is McIlvaney.com. Thanks for listening and have a great week.